everybody, it's your pal JR, and welcome to Assume I'm an Idiot, the show where we take complicated topics and sift out all the mishigosh till just the dullard safe parts remain. I am the idiot.
I am an idiot.
And on this podcast, we'll be exploring everything from silly fun facts that everyone should know to bigger, more complicated topics like finance, education, science, business, and so much more. Broken down without corporate talk or industry speak, so even a chucklehead like me can understand. So ease back in your seat, loosen up that mind of yours, and let's figure out how things really work, minus the confusing word salad and highbrow gibberish. Today we're talking about something that sounds intimidating, but actually, no, it's really intimidating. But first, it's time for Random Stuff You Should Know.
Random stuff you should know.
From the world of science.
Yippee, hooray, science.
Actually, it could be from science or nature, but let's say science.
Science.
Bananas are radioactive, but only a little. Bananas contain potassium-40. That's a natural radioactive isotope. Eating one slightly increases your exposure to radiation, but only slightly. In fact, you could eat 100 and it wouldn't make a difference. You'd need to eat 10 million bananas in one sitting to be in any kind of trouble. And if that ever happens, radiation is clearly not your biggest concern at the moment. Your body exploding is probably a bigger deal. Also from the world of science.
Science.
Rain has a smell, and that smell is bacteria poop. The scent of rain, called petrichor, partly comes from bacteria in the soil releasing tiny molecules when raindrops hit. Those molecules get launched into the air and up into your nose, and they are bacteria waste. So yes, when you say, I love the smell of rain, what you really mean is you love the smell of bacteria excrement, so enjoy that. Okay, on to the main topic. Today we're talking about something that essentially controls our entire economy, whether we like it or not. And there's really nothing we can do about it, so it's probably a good idea to understand, at least in part, how it works. And that something is the stock market. What is it? Where did it come from? Why does it dictate our entire financial life? And why the heck should we care about dumb stuff like pork bellies? Now, because I have the IQ of a single-celled organism, I'm going to bounce around a little bit, but I promise at least one of us will learn something today, so hang on. I actually learned about the stock market when I was just a kid. I didn't know I was learning about it, but I was. When both my sister and I were born, my grandparents bought us each $100 worth of stock in the pharmacy chain Rite Aid, which actually just closed its doors for good about a month ago. Now, obviously, I didn't know about this gift as a baby, not until I was about 8 or 9 years old, when my sister made the horrible mistake of telling me that somewhere out there, I had money that belonged to me. And I wanted that money. Didn't even know how much it was, but I knew it was mine. I didn't know what shares were. I didn't know what the stock market was, but I knew I wanted to buy stuff and I demanded answers. So, when I say I learned about the stock market, I mean my grandmother explained all the good things that would someday come from a gift that I couldn't see, touch, play with, or use in any way, as long as I left it alone, forgot about it, and did not pester her about it. If I was patient, one day I would be drowning in riches, and oh, what a glorious day that would be. Fast forward about 10 years, the day before I left for college. I received an envelope from my grandfather. He proudly announced that they finally cashed out my stock so I could use it for school. Oh my goodness. 18 years of waiting and now my ship had finally come in. In a millisecond, a full shopping list of everything I wanted to buy flashed through my head. A car, a set of drums, a full stereo for my dorm room. Heck, maybe I'd even have something left over to pay my student loans. So I tore the envelope open like a crazed animal and found a check from the Rite Aid Corporation for a whopping $422. That day I learned everything I needed to know about the stock market, and that is, maybe the stock market isn't for me. But that old lesson in disappointment did lead me to ask, do the bulk of people know how the stock market works? And moreover, do they know just how much it affects their day-to-day lives, even if they aren't in any way involved or invested in it? So I decided to look into it. Now remember, I'm a moron.
You're a moron.
But hopefully my rudimentary research can help you understand the who, what, when, where, and why of the stock market. Let's get a little history here. Let's discuss how this financial bedlam started, just so you have some good trivia for your next cocktail party. No other reason. The first stock exchange did not start in New York. It started in Amsterdam in 1602. The Dutch East India Company needed money to fund risky global trade voyages. So they did something wild at the time. They let regular citizens buy part of the company, shares. You could literally own part of a spice trading empire. Other companies started to see the benefit of offering a piece of their company to get large sums of upfront money, with the promise that, if everything went to plan, those owners would get more back than they put in, because the company would be more valuable. That was the birth of modern stock buying. Fast forward to the late 1700s. The origin of the New York Stock Exchange traces back to May 17th, 1792 in Lower Manhattan. At the time, New York was already becoming a busy port city and commercial center. Merchants were already trading government bonds and shares of early banks. We'll get to what that means in a minute. But there was no organized marketplace for it. Instead, trading was really super messy. Brokers would gather in coffee houses, on sidewalks, or wherever they could meet to negotiate deals. The prices weren't standardized. Commissions, or how much traders got to keep whether the stock market made or lost money, were all over the place. And competition between brokers could get chaotic and even deadly in some cases. Brokers, for clarity's sake, are simply people who buy and sell stocks for others. That's all. There's nothing super fancy or special about it. They're salesmen. So a guy could be selling Hyundais one day and selling stocks the next. So, a group of 24 stockbrokers and merchants decided to formalize things. They met outside 68 Wall Street under a buttonwood tree, which is a type of American sycamore, and they signed a document that would become famous, the Buttonwood Agreement. The Buttonwood Agreement, in short, was a simple document with two rules. The brokers agreed they would only trade securities with each other. No riffraff allowed to shove their dirty commoner money into the mix. And they would charge a fixed commission rate of 0.25%. That might not sound like a lot, but it was revolutionary at the time. It created a closed network of trusted brokers, which reduced fraud and brought order to this chaotic securities market. In other words, it created the first structured security exchange in the United States. And I will explain securities coming up. What were they trading back then? Well, early trading wasn't about giant corporations like today. Most of the securities traded were government war bonds, shares of early banks, insurance companies, and all of those things, securities, shares, etc., are all a little bit different, but we'll talk about that in a second. The young United States government had massive debt after the Revolutionary War, so bonds were a major financial blanket, okay? Alexander Hamilton, the first Treasury Secretary of the U.S., strongly supported creating stable financial markets to help cover and manage that debt. So in a way, the early stock market was deeply tied to building the financial foundation of a brand new nation. For the first several years, trading continued in informal meeting places. Eventually, the brokers moved indoors, often meeting at a place called the Tontine Coffee House. Coffee houses in the 18th century worked a lot like today's kind of big financial hubs. It's places where merchants got together to exchange news, to negotiate deals, to gossip about the markets, and so on. In 1817, the organization finally formally adopted a constitution and renamed itself the New York Stock and Exchange Board, which eventually evolved into the New York Stock Exchange like we know today. Through the 1800s, the exchange expanded as the American economy exploded. By the late 19th century, Wall Street had become the financial center of the United States and in some ways the world. And blah, 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 the stock market gets bigger over time. I don't want to do a full history lesson here. There's much more to it, but that's enough to get you through a trivia challenge in a bar somewhere. But one important thing is the general public was not involved in stock trading for a long, long time. It was basically an elite society of wealthy people and institutions until the 1920s. So as promised, really quickly, let's talk about the difference between securities and stock, okay? Let's talk about what a stock is. Let's say your friend starts a lemonade stand. It's a great stand and people love it. But your friend needs more money to buy lemons, cups, maybe a cool umbrella, I don't know. So your friend says, if you give me $10, I'll give you a tiny piece of ownership in my lemonade stand. That tiny piece of ownership is called a stock. You own a small part of the company. If the lemonade stand becomes super popular and makes lots of money, your piece becomes more valuable because the company as a whole becomes more valuable. Now, how is that different from a security? Imagine there are a lot of different kinds of money agreements people can make at this lemonade stand. For example, they can own a part of the lemonade stand, they can lend money to the lemonade stand and get paid back later, or they can make a deal about what the lemons will cost next month. All of those kinds of financial deals are called securities. So a security is just a big umbrella word that means something you can buy or sell that represents money or an investment. The easy way to remember this is, think of it like animals. Animals is one big category. Dogs are a specific animal within that category. So securities is the big category. Stocks is one specific type of transaction within that category. Got it? Okay. So then I mentioned stuff like bonds. Inside the securities family, you have all types of specific financial items. Stocks being one of them, that's owning part of a company. Bonds, which is lending money to a company or a government. Or funds, which is a basket of many stocks together. So every stock is a security, but not every security is a stock. That can be a little confusing. When did the stock market really take off, really have its big burst? The modern U.S. market began gaining steam in the late 1800s during the Industrial Revolution. Stuff like railroads, steel, oil, big banks. Massive infrastructure projects needed massive capital. Investors funded the expansion. Regular people didn't participate in big numbers until the 1920s. Okay? The 1920s is when speculation exploded. So what's the difference between an investor and a speculator? Let's say both an investor and a speculator are looking to buy the same baseball card. An investor buys it because they like the card and they want to hold on to it. A speculator buys it only because they think someone else will pay more for it tomorrow. They don't really care about the card itself. They're thinking, if I buy this for $10 today, maybe I can sell it for $15 next week. That's what a speculator is. So speculation means buying a stock mainly because you think the price will go up soon, not because you believe in the company long term. You're making a bet on the price, not on the business. Anyway, I'm bouncing around. But what I was saying was, regular people didn't really participate in the market in big numbers until the 1920s, when speculation exploded, post-World War II expansion, the rise of pension funds, the birth of the 401k, which happened in the 80s. Okay, those were the things that really triggered people getting into the stock market. In particular, 401ks, once retirement savings became tied to the stock market, everyday Americans became investors, whether they wanted to be or not. So if you have a 401k, you are in the stock market. It's not a savings account. It's a trader using your money to try, not always successfully, to make you more money for retirement. Okay. Some people get confused about the difference between the New York Stock Exchange versus NASDAQ. So what's the difference? Let's clear this up because it confuses everybody. The New York Stock Exchange is, let's think of it as the old school one. It's the big iconic building. It used to have people physically yelling and waving papers on the floor. They don't really anymore. It lists many large established companies, right? Big corporations, Coca-Cola, Walmart, McDonald's, big industrial firms. The NASDAQ started in 1971 and was specifically designed to eliminate a big problem that the stock exchange was having in the 60s. It was slow, it was messy, and not very transparent. Prices weren't always very clear, traders couldn't take time to confirm prices, and smaller companies had little or no chance of getting listed on the big exchange. So, regulators and the financial industry tried something new. In 1971, the National Association of Securities Dealers created NASDAQ, which stands for National Association of Securities Dealers Automated Quotations, which is a ridiculous mouthful that sounds like it's written by a robot lawyer. But the important word in there is automated. NASDAQ was the first electronic stock market in the world. Okay, instead of traders shouting out orders in physical trading floor, like on the stock exchange, NASDAQ used computers to display prices and connect buyers to sellers. This was revolutionary at the time. Nowadays, people sit in their underwear and trade stocks on an iPhone. Before NASDAQ, the idea of trading without dedicated brokers was ridiculous. In fact, NASDAQ was such a crazy concept at the time, most investors avoided it because they thought it just wouldn't work. Now, NASDAQ traditionally has catered to tech companies. Because NASDAQ was newer and more flexible than the New York Stock Exchange, it became a natural home for young, fast-growing companies, especially in technology. Over time, it became the exchange where companies like Microsoft, Apple, Amazon, Google, Meta chose to list their stocks. So while the New York Stock Exchange often represents older, traditional, big corporations, NASDAQ became associated with innovation and technology and quick-growing companies. They're not mutually exclusive, but that's a pretty good generalization. Regardless, both are just marketplaces. They're like two different malls selling ownership instead of sneakers and Wetzel's pretzels. So that's a very fast history lesson of where it started and why. Now let's start breaking this all down and try to parse some of the more confusing language. We talked about the difference between investors, speculators, what a stock is, what securities are, and a little about bond funds. But what the heck are futures? Because here's where things start to feel weird and imaginary. A futures contract is an agreement to buy or sell something at a specific price on a specific future date. You're not buying the thing today. You're locking in a price for later. For example, you're a farmer growing corn. You don't know what corn prices are going to be at harvest time. You're nervous, so in April, you sell a futures contract saying, I agree to sell 1,000 bushels of corn in October for $5 a bushel. Now you have certainty. If prices crash later, you're protected. On the flip side, a cereal company might buy that contract. They lock in their costs. They avoid surprise price spikes. It's basically insurance. And this is where we start talking about pork bellies. Why pork bellies? Why orange juice? You will often hear pork belly futures as an indicator, of sorts, of how strong agriculture is. In the 1800s and 1900s, futures markets became popular in agriculture because farmers needed stability and food producers needed predictability. So markets formed for corn, wheat, soybeans, cattle, pork bellies, frozen concentrated orange juice, and so on. Yes, orange juice futures are a real thing. If you've ever seen the movie Trading Places, that's what they're all screaming about at the end. The idea is simple. Lock in prices ahead of time to reduce risk. And it's all a great idea. But then those pesky speculators came into the picture. People who have zero intention of ever touching an orange or a pig. They just bet on whether pork prices will go up or down. Now we're not just hedging the risk, we're gambling on expectation. That's when the stock market starts to feel like some kind of crazy secret club. So yes, we are trading things that don't even exist yet, because humans hate uncertainty. You can trade oil futures without owning oil. You can trade currency futures without even leaving your house. You can trade interest rate futures based on what you think the Federal Reserve might do to interest rates. It's economics layered with psychology, layered with prediction. All of those things together sound nasty. Sometimes I imagine explaining futures contracts to my grandparents who bought me that stock so many years ago. I'm buying futures contracts, Grandma. So you're buying bacon that hasn't been born yet? Yes. And you're selling orange juice that hasn't been grown, harvested, or squeezed? Yep. And people bet on this? They sure do. And they make money on this? Sometimes. At some point, the economy becomes less about pigs and oranges and more about confidence. That's a super important word to remember. It's like we built a giant machine that runs on optimism, fear, and math, mostly fear. But market confidence is one of the great yardsticks of an economy, okay? Which leads me to, why is our economy tied to the stock market, or more specifically, to futures? Because the stock market is a capital engine. It funds business expansion, research and innovation, infrastructure, the job market, hiring. When markets rise, companies feel rich and confident. They expand. When markets fall, companies tighten up. They lay off workers. They slow down projects or put projects on hold indefinitely. You add that to retirement accounts, pension funds, institutional investing. Institutional investing is very large organizations investing huge amounts of money for lots of people at once. It's like the difference between one kid buying a lemonade and the whole school buying lemonade together. Okay? So with all that, now the stock market isn't just rich people playing games. It's teachers' pensions, it's firefighters' retirement, it's your 401k. So when the market drops, it hits regular old Joes like us, not just Richie Riches. So there's a good and a bad to our economy being tied to the stock market. The good is it raises capital, it definitely encourages innovation, it allows wealth building, and it spreads ownership of companies to average people. You have a voice. Once you own stock in a company, you have a vote in what happens in that company. Okay? You hear something like, we have to do this for our investors, or we can't do this without the approval of our investors. That's you. The bad of it, of course, is that it can inflate economic bubbles. It encourages very short-term thinking. It amplifies inequality, for sure, and it reacts emotionally. The market isn't evil. It's human, and humans overreact. And that reaction causes ups and downs. And those ups and downs directly or indirectly affect the cost of everything you do, wear, eat, drink, drive, and live in, as well as whether or not you have a job. So I mentioned the importance of market confidence, and here's why that's important. Like I said before, I know I'm jumping around a little bit, but that's how my insect brain works, so stick with me. Market confidence leads into the part everyone is deeply afraid of and secretly expecting to happen. The crash, the stock market crash. Because the stock market doesn't just go up, sometimes it dips and sometimes it falls off a cliff. For the sake of definition, a stock market crash is when prices drop dramatically in a short period of time, usually 20% or more, often in days or weeks. And here's the uncomfortable truth. Crashes usually don't happen because something small went wrong. They happen because something big was already wrong and everyone pretended not to notice. So the easiest way to understand crashes is to look at the famous ones and why they happened. We'll start with the classic. 1929, the Great Crash, also known as Black Tuesday. That's the one that broke the whole system. Okay? In the 1920s, the stock market was absolutely booming. People were buying stocks on margin. That means they were borrowing money from banks and investing it in the stock market. Basically, they were gambling with borrowed cash. Stock prices kept rising and rising, and everyone thought it would never stop. Then, in October of 1929, market confidence cracked. It cracked mainly because stock prices had been rising much faster than the overall economy had been for years. Millions of people were buying stocks on margin, money that they borrowed, which means they only put a tiny little bit of their own cash into stocks. When a few concerned investors started selling off stocks and prices began to dip, people who had borrowed money had to sell quickly to repay their loans. They were worried they wouldn't be able to pay their loans back. That triggered more selling, which pushed prices down again. The panic spread, investors rushed to sell before losing everything, and the market collapsed. Okay? In short, stocks were overpriced, lots of people were in debt, and once the prices started falling, panic selling made the crash snowball. Stock prices hit rock bottom, banks failed, businesses folded, unemployment skyrocketed. The market lost $14 billion, at the time 50% of its value, in just a few days. And that was just the initial crash. It eventually lost nearly 90% of its total value. That crash didn't just hurt investors, it triggered the Great Depression, which lasted about 11 years. Now, the stock market didn't cause the depression all by itself. There were deeper banking and policy issues going on, but it was the spark. Let's fast forward to the 1980s, 1987. It was called Black Monday, the Black Monday crash. In one single day, October 19th, 1987, the Dow Jones dropped 22% in a single day. For reference sake, the Dow Jones, usually just called the Dow, is not the whole stock market. It's just a measurement of how 30 large U.S. companies are performing, okay? Think of it like an average or a scoreboard. These companies include big, well-known companies like Apple and Coke and Microsoft. And when their prices go up or down, the Dow Jones goes up or down. So the stock market equals thousands of companies being traded. The Dow Jones is a small sample used to track how some major companies are doing. It's basically a quick way to see the general mood of the market, but it doesn't represent the entire stock market. So anyway, Black Monday, 1987, a 22% drop in one day. As a point of reference, a 3 to 5% drop is considered a very, very bad day on Wall Street. So 22% was historic and catastrophic. It wasn't tied to a clear economic collapse. It was partly automated trading systems reacting to each other. Computers triggered sell-offs. That triggered more selling, which triggered more selling. It was the market panicking at machine speed. Some call it a computer glitch, which is really minimizing what happened that day. The experts were ignoring warning signs of how computers would react to certain conditions, and it kicked them in the teeth. Luckily, the broader economy stayed intact, but it showed us something important. Sometimes the market crashes because of complacency. Fast forward again to 2000, the dot-com bubble. In the late 1990s, investors threw money at anything with a .com in its name. Companies with no profits, no product, sometimes no actual business plan, just cool vibes and a website. Eventually, people realized, oh, these companies don't make any money. That's when that bubble burst. Tech stocks collapsed and billions evaporated. But once again, somehow the economy survived. The bubble burst, but it didn't trigger a notable recession, unless you owned a tech business, in which case you were absolutely screwed. And lastly, 2008, the big one that we all probably remember. This one really hurt. Banks were offering very risky mortgage loans and selling them like they were safe. Okay, they were considered risky because they were primarily something called a subprime loan granted to borrowers with poor credit, low income, or no proof of employment. These loans often featured teaser rates, right? Really low rates that at a future date would reset to an unaffordable high interest payment. That led to mass defaults when housing prices eventually stopped rising. Housing prices were rising, people kept borrowing, Wall Street kept bundling debt. Then housing prices stopped rising and the whole system went kaput. Lehman Brothers, a major global investment bank, had to file bankruptcy. That made credit markets freeze. The stock market plummeted nearly 50%. And this time, the economy as a whole did not survive it. It triggered a global recession. Millions of people lost homes, millions lost jobs. This is when people realized the stock market isn't just numbers. It's deeply tied to banking, credit, housing, everything. A nasty, painful wake-up call. Very quickly, let's talk about how a stock market crash can trigger a recession. Here's the mechanism. When stock prices crash, companies lose value, investors lose wealth, retirement accounts shrink, confidence collapses. When confidence drops, consumers spend less, businesses stop investing, hiring freezes, and layoffs start. And because the stock market is tied to banks, pensions, and corporate borrowing, crashes can freeze credit. If a business can't borrow money, they cannot expand. If consumers can't borrow, they can't spend. And now you've got lower spending, lower production, higher unemployment. That's a recession. The stock market doesn't always cause recessions, but it can amplify problems or expose weaknesses that were already there. It's kind of like starting a fire in a building that already had faulty wiring and was going to burst into flames anyway. So why are crashes so violent? They're called crashes for a reason. They're violent because markets run on psychology. When prices rise, greed kicks in. When prices fall, fear kicks in. And fear spreads far faster than optimism. And thanks to technology, trading happens instantly now, so panic can spread instantly. In 1929, panic traveled by newspaper. Today, it travels by push notifications. And here's the strange paradox. Market crashes are terrifying. We, of course, want to avoid them. But they're also part of the system. They're kind of worked into the equation. Markets correct excess. The economy hates when a company gets too big. Bubbles burst. The economy hates flash-in-the-pan moneymakers. Weak companies fail, strong ones survive. In a matter of speaking, it's nature's way. Historically, markets recover over time. But in the moment, it feels like civilization is ending. Sometimes I imagine the stock market as a giant stadium wave. Everyone stands up at once, cheering and optimistic. Then someone forgets to stand. A few people see it and they sit down. And before you know it, the whole wave collapses and everyone's yelling, "Who started this stupid thing?" Now, I've heard people kibitzing and asking, are we due for another crash? That's the question everyone whispers whenever the market's been rising for a while. Are we due? Here's the uncomfortable but honest answer. Markets do not crash on a schedule. There's no cosmic calendar that says every 12 years we're going to have a financial apocalypse. But markets do move in cycles. There are periods of expansion, optimism, rising prices, followed by overconfidence, overvaluation, correction, and then sometimes crash. So the cycle I mentioned, that cycle has a lot to do with market correction, okay? That's when a stock drops about 10% from its most recent high, and that's normal. It happens regularly. Think of it like your body cooling down after an uphill sprint. You can't run uphill forever. You've got to take a pause. There's bull markets, there's bear markets, terms we've all heard, and that's not super important. other than those are both types of market correction. But here's the key. Corrections are not crashes. Corrections are part of the natural breathing pattern of the stock market. Historically, markets correct every couple of years. They crash far less often. And over long periods, they tend to recover. Now, could a crash happen again? Of course, because human beings still exist. And markets are, in a sense, a human behavior scaled up to trillions of dollars. Okay? Even computerized trading is controlled by human beings. So I keep saying or referencing how the stock market affects your day-to-day life, cost of living, etc. Here is a lightning quick and very topical example of the reverse, the human influence on the stock market. Here's what I mean. Let's say oil prices start to climb up. Imported oil, not domestic oil. Increased oil prices means increased gas prices. Increased gas prices means people have to spend more at the pump, so they have less disposable income to buy stuff. It also means increased manufacturing costs because manufacturing relies on oil and oil-based products too. So does farming. Farming equipment uses fuel. So stuff starts getting more expensive for a market who's already spending less because of the gas prices. Both companies and consumers get nervous. Both stop spending or borrowing. That's the beginnings of inflation, a yucky hot-button word that gets people all riled up. The all-important consumer confidence drops. The stock market falls, it spreads and affects other business segments. The cause and effect cycle begins, and before you know it, everyone is tightening their belts, pointing fingers, and things get really scary. All from a single product becoming more expensive, even by a few dollars. That's how much the stock market affects your life and how much your life affects the stock market. As that illustrates, here's the insane part of the system that's hard to grasp. The stock market affects the economy, and the economy affects the stock market. And all of it affects your wallet. It's a kooky infinite loop that I don't think the founders of the stock market had intended, but intentions or not, that's how it is. Anyway, another type of market correction is something that sounds dramatic but really isn't. A stock split. Imagine a pizza, you own one slice, and it's worth $100. The company decides to do a 2-for-1 stock split, so they cut the slice in half. Now, instead of one slice worth $100, you have two slices worth $50 each. Did you gain anything? No. Did you lose anything? Nope. You just have more slices at smaller size. That's a stock split. Companies do this when their stock price gets very high. If one share costs $1,000, it can feel intimidating to a smaller investor. But $500 isn't as scary, so they split it. More shares, lower prices per share, same total value. It's psychological. It makes shares feel more accessible to people. So why do people get excited about stock splits? Because even though nothing fundamentally changes, investors often treat splits like a signal of confidence, which I said is super important. When a company announces a split, people think, oh, the stock must be doing great, so demand can increase, which can push the price up, which makes people feel smarter or feel like they're getting richer. Here's the thing about crashes, corrections, splits, futures, exchanges, all of it. The stock market is not a mythical system. It's a human system, built by humans, run by humans, influenced by human emotions. So, let's wrap this up. What is the stock market? The stock market is a global ownership marketplace. It started in Amsterdam, it grew under a tree in New York, it exploded during the industrial expansion, it finally went digital, and now it lives on your phone. It can create wealth, it can destroy wealth, it can fund innovation, it can amplify greed, it can upend everything. But underneath the flashing numbers, it's just ownership and expectation. And if you zoom far enough out, it's one of the most powerful capital engines ever built. Is it flawed? Absolutely. Is it necessary? For modern capitalism, let's say probably. And like it or not, it controls your entire financial life, whether that's your employment status, your groceries, your gas, your car payment, your mortgage, or your retirement. It looms over the whole shebang. And for those that stay away from it and simply put their money into a savings account, yeah, the stock market controls that too. Your interest rate is, at least in part, dictated by how successful the market is. But no matter how you slice it, no matter the fancy terms, the stock market is gambling. Regulated and legal, but it is gambling. regardless of big smart people in big smart suits telling you they can predict this or guarantee that, it really comes down to 10% education and 90% luck. Don't let anyone tell you otherwise. We didn't really get into it, but regardless whether your stock goes up or down, a human somewhere still makes a commission. Somebody gets richer even if you get poorer. And if that's not capitalism, I don't know what is. The stock market is a human system. And just like humans, it's incredibly unpredictable. At times, it works beautifully and exactly how it was intended. But it's also a living, breathing thing and will sometimes just do whatever it wants. The best way to describe it in a nutshell is the stock market works to keep the world economy turning until it doesn't. Or put another way, good luck and Godspeed. That does it for this time. Thank you for listening. I hope you learned at least something. I did, but if history has taught me anything, I probably won't retain any of it. Feel like berating me and telling me everything I got wrong? Just want to say hey or get something off your chest? I'd love to hear from you. Send your emails to hello@ruffandtumble.com. That's hello@ruff-n-tumble.com. Join me for another upcoming episode of Assume I'm an Idiot. I'm your pal JR. Catch you again soon.